Good evening and happy 2015 to everyone. Interesting days in the bond market. In our last email update that we sent out Christmas Eve, we noted that long-term interest rates had spiked higher, with the 10-year going above 2.3%, after we saw revised, an upwardly revised Q3 GDP figure of 5%. The market got a little euphoric about that. There were calls that, all right, now long-term rates are finally going to go up. We doubted that, not with the German 10-year below 50 basis points and the French 10-year at about 75 basis points, 73 basis points, I think is where it ended today. There's just too much of a pull there. So our call was that buyers should come back into the market, and we could see the 10-year Treasury yield move back down towards 2% by the end of the year. At the end of the year, somewhere around, if I remember correctly, and we had it in today's report, somewhere around 213 or so. Today, it closed around 197. It got down to 188 yesterday. And this in spite of stronger economic data here. And this has people saying, geez, does the bond market see a recession coming for the United States? Something's not quite right. Even Jeff Gundlach, who we respect very much around the office as being a knowledgeable bond guy, he was out there saying, look, when we see high yield credit spreads widen, we'll have them blow out, which they have. A 5-year single B paper the spreads have widened by about 120 basis points since last year. Meanwhile, the 5-year Treasury yield has dropped about 10. So that usually does, Mr. Gundlach is right, that usually does spell trouble in the economy when you start to see such a risk-off mentality. But we don't think the trouble it reflects is necessarily in the U.S. economy. Remember where a lot of the high yield money went. It went into the energy sector. Why did it go into the energy sector? Because global demand was supposed to rise. It was supposed to outstrip new production. And what's happened is that new production has actually outstripped the increase in global demand. So we did a little research. And since the housing bubble, we have it here. We've seen domestic crude, and you can see it right on this chart. Hopefully you can see. Domestic crude production is up since before the financial crisis, is up about, what are we now? 42%. Domestic production has increased 42%. On a global scale, we have, and this is from British Petroleum and Bloomberg. We have total production was up about 6%. Right, it was up 6%, and consumption was up 5.5%. So what we have here, I got your consumption chart. All right, and notice how it gets steep and it starts to flatten out up here. Global consumption is starting to flatten out a bit, So it's not going to go flat. We'll still see consumption increase as economies develop, but they're probably not going to develop as quickly as before. China is not going to run 8%, 9%, 10%. It's probably not going to run 7% after a few years. All right. So what's consumption going to look like with demographic situations, even in China, where population growth is going to reverse, that population contraction by design? Yes, you'll get some increase because of a rising middle class. But you have Japan with a shrinking population. Europe is stagnating, and the U.S. population growth is more moderate than it was before. Throw into that efficiencies. Like I said this once in a previous broadcast. Dodge makes a full-size Ram pickup that does 28 miles to the gallon. My wife's 2011 4-cylinder Subaru Impreza that does about 26. So vehicles have gotten more efficient over the years. So the per capita consumption is actually less than it was before. Maybe low oil prices will increase consumption, and oil prices will bottom at some level. But where that bottom is and what's the natural rate, that remains to be determined. So, and nobody knows at this point. There's a lot of conjecture. We remember when oil hit 80, they said, 80 is about the bottom, then 70, then 60, then 50. Well, now we're in the 40s, and there's no sign that it's going to stop anytime soon. the popular thought was the Saudis and OPEC, they'll come in and they'll cut production. Well, good luck, because if they cut it, there's plenty of excess production around the world that's either online or can be brought online rather quickly, and all they'll do is lose market share. And gee, if you can get your oil at the same or lower price elsewhere, and why not? And then you sign contracts, you strike relationships with other suppliers, and then just sitting out in the cold. And this is evidenced by Russia and Iran, which are both producing record amounts of crude, more than ever in the case of Iran, and the most since the Soviet days for the Russians. So nobody's turning the spigots off. And think about it, in the case of Iran and Russia, where else are they getting revenue? They're one-trick ponies. And in the U.S., if you have a well that's online, and you've borrowed to do this, you have loan and bond payments to make. Well, you need to generate some sort of revenue. You default on the bonds, your creditors come in and take and take your well. Still there are companies that are going to take wells offline. We read a report the other day that in the last week, 20% of Canada's wells, remember those are usually higher cost wells, have been taken offline. So the criticism out there for the doomsayers was that, look, oil prices have been low for months, and we haven't seen any layoffs yet. Layoffs lag. They're not going to do it over the holidays if they can help it. They're sorting out what their demand's going to be, what their real cost of production is, and we'll probably see some layoffs in the oil sector and in industries that service the oil sectors, and even in local service businesses that service the companies and the oil workers. We had around Eagle Ford in Texas and in the Bakken in North Dakota, even fast food workers are making $20 an hour. That could be a thing of the past, going forward. If that's not a contradiction what I just said, but you could see that those conditions evaporate. They'll go away. So this is going to have farther reaching effects than what the cheerleaders like to say. Now, we've said it before, this is still more positive than negative for the U.S. economy, for GDP. But it's not 100% positive. Not like it might have been 10 or 15 years ago when U.S. oil production was much less than it is now. And there wasn't so many investment dollars in the sector, and so many people relying on that sector for employment for their daily lives. So it's going to have more of a negative impact than it had before. So it's not just a positive. Now, people have been reaching out trying to draw correlations between now and 2009, the last time oil was down into the 40s, or late 2008, when last time oil was down to the 40s, and they're trying to draw parallels how it came back and and how it dropped and which led the recovery. What we have to understand that in 2008 and 2009, the drop in the price of oil was through demand destruction. We had the most severe financial downturn since the Great Depression. Right? So the demand for oil was across the board. It was from consumers, it was from businesses, you name it. The consumption of oil just fell off the table. That's not the primary cause this time for the drop in oil. We have an abundance of supply. We remember back in, I think it's 2003, when they were speculating that maybe someday, if oil prices were high enough, and the technology improved, we can get oil out of shale. But that was not a guarantee. And then in 2006, when oil was starting to broach $100, it was like, oh, the Canadian tar sands were now profitable. Well, Canadian tar sands are profitable in the 60s, and there are areas of this country in shale that are profitable in the 40s. So, and that's what it'll do. It'll drive an efficiency movement. So where these companies, at least some of them, will be profitable at these low levels, and the ones that can't be profitable will fade out. Will file for bankruptcy. Will be gobbled up by bigger competitors. They'll go by the wayside. This afternoon on CNBC, they had Kevin O'Leary, you might see him on Shark Tank. He's also Mr. Wonderful. He's not the most congenial guy in the world, but he's right much of the time. And his argument was, some of these high yield companies, oil companies, need to fail. The inefficient management needs to be brushed aside. These companies need to go away because they're clogging the space. They're consuming capital that can be better used elsewhere. Now we thought back, gee, we've written about this for months and months and months, and the response we usually get from readers or viewers or even some of our coworkers is, well, that's bad. Investors will lose money. A lot of people, put their money into this. They were told that these were good investments. All right, let's get this straight. A single B rated debt instrument is never a safe investment. I don't care who analyzed it. I don't care who went through the data, what business they're in. It is never a safe investment. It might be a good investment in the end. It might pan out if the company's well managed and the business sector performs well and financing costs remain affordable, but it's never safe. It's B rated for a reason. Yeah, you can complain that the rating services don't always get it right and there's a conflict of interest, but it's an aggressive investment. And what's happening now in the high yield sector is the market is starting to realize this. In fact, the institutional side of the market, it realized this a couple of years ago. And you saw that by the summer of 13, the institutional participation in the loan market, and a lot of the loans were taken out by energy companies, that kind of dried up, and the Fed wrote that in a September 30th, 2013 report that's a concern they have. But retail kept plowing money in, and by June of 2014, the credit spreads of junk bonds were the tightest in history, with the exception of, yes, the housing bubble. But that was okay, because wholesalers came through all the branch offices, and financial advisors told their clients, look, this got room to tighten. They're not as tight as they were the last cycle. They can get that tight again, and the Fed is never, ever going to do anything that will upset the apple cart for these companies. Bull. Quite plain and simple, bull. Okay? There was very little chance that credit spreads were going to get to those tight levels when interest rates, benchmark interest rates, were, if I can remember correctly, are about 400 or 350 to 400 basis points, depending where you are in that 3 to 5 area of the curve, lower than they were the last time credit spreads in junk were very tight. All right. At some point, the absolute yield is too low. So institutions looked elsewhere. In fact, a lot of movement to munis when silly investors bailed out of munis because of Detroit and Puerto Rico, like that was going to affect New York State throughways. But that's another story for another broadcast. So that wasn't going to happen. And so everybody's waiting now for junk bonds to correct back to where they belong. Hint, they have, and they still are. Okay? Then one thing that irks us at Bond Squad is the predisposition for investors and sometimes financial advisors to view the high price, especially when they bought at the high price, to be the real efficient price and not the new lower price after a downturn. Okay, we've heard comments like, these have sold off for no reason. That may be the case with some, but we'd argue they went up for no good reason. Okay, they went up because of momentum, because the Fed pushed capital into those assets, and now people are looking under the hood. Hey, what's that bond really worth with oil at 48? What's their business model look like? What's their debt load? When does debt come due? Oh, gee, the Fed's going to raise short-term rates. And by the way, the Fed, they said probably not through the April meeting, but the minutes also indicated that the Fed could tighten policy even with inflation well under 2%. But we'll discuss that a little later. So with that happening, especially if you have floating rate loans, and it's like, well, gee, that's great if they raise the Fed fund rate, that pushes LIBOR up, and I get a higher coupon. Yeah, but that's also higher debt expense for the issuer, and they're getting less per barrel of oil. So that sets up a bad dynamic for junk bonds, especially in the oil drilling and exploration sector. We've always been of the opinion, and that when looking at debt in the energy sector, in that oil and gas sector, look at midstream, look at the pipelines, because we're not going to stop pumping oil at these low prices. All right, it's going to keep coming. All right, they're going to get more efficient. The weaker sisters are going to get pushed out, but we're going to keep pumping oil. And in fact, with low oil prices, at least theoretically, the demand for oil should rise. People consume more. They're a little less budget conscious. So the pipelines, whether it's coming out of the ground in Bakken, whether it's coming out of the ground in Eagle Ford, whether it's coming off a ship that's pulling up to a pier somewhere and unloading it, it's going to go through a pipeline. It's going to go to a refinery someplace, right? So it's going to be transported. So the pipeline is going to be active. And remember, the pipeline is the cheaper method versus rail, and the more efficient method versus rail of transporting oil. So if we do have less production here, and you don't need all the capacity you have to transport, well, what's going to go away first? The highest cost transport, and that's going to be rail. So the pipelines should continue to get a steady stream, literally, of oil. So the question we've been asked, well, they've sold off too, along with the drillers. If they're so good, why have they sold off? Because many participants, especially on the retail side of the business, they didn't buy drillers, they didn't buy service companies, they didn't buy pipelines, they bought energy. And energy's down, so sell me out of my energy. So they sell, and they sell their pipelines. And any managers out there, who have a mix, well, you get a better bid on the pipeline companies, so you sell what you can, not necessarily what you want. So the babies do get thrown out with the bathwater. We're asked, where are the babies in the drilling bathwater? Hard to say. There's a few names out there that we think, more than a few actually, that could probably survive this and end up in good shape down the road. The problem is what you get is a bank run scenario. In a bank run scenario, investors start pulling their capital out of the sector altogether. And even the viable companies have difficulty obtaining financing. So, and that creates a It's a Wonderful Life George Bailey scenario. If everybody takes their money out at once, even a good company becomes insolvent. So and we don't know when and where and who that's going to happen to. All right. So, we can, if you call us, we can give you some recommendations. But you're probably better off just staying in the energy pipeline sector, and look if you're doing drillers, look for natural gas exposure. Natural gas is not easily transported from overseas. We have some of the largest reserves. We're profitable down here, $3 or so per million BTU. Natural gas is consumed more and more each year. It's probably going to pass coal as the #1 producer of electricity if it hasn't done so already. So look at that. Yeah, they've sold off too. Silly, but they've sold off. So that's where you might want to look. There's some hope that the ECB launches QE, and that reinvigorates Europe's economy and sparks energy consumption. We had an interesting conversation with a very experienced and well-known and respected fixed income strategist who works for a major investment firm on the street. And we went back and forth, and we both agree that Europe's problems are structural. And I opined that Europe reminded me of Japan 15 or 20 years ago. And the response from the strategist, who's also a subscriber, said, yes, zombie banks, aging population, inward-looking, politically dysfunctional. She meant that about Europe. So Europe has a major problem. Its problem is not that money is too expensive to obtain. The German 10-year is 44 basis points. The French 10-year is 73 basis points. Italy and Spain are in the low ones, and Ireland's 10-year broke below 1% today. It's not the interest rate problem. No one, or not enough people, want to borrow or need to borrow. Business startups are few and far between, given the size of the EMU economy. They're structurally rigid. They're not the animal spirits. They don't exist the way they do here, and to structurally rebuild the economies over there to encourage growth, it would probably mean a good deal of losing benefits, job security, vacation time. The way of life would change. And you have an aging population over there, and this aging population holds most of the jobs. These people don't retire. They hold on to the job as long as they can. The youth unemployment is extremely high, and it's in their best interest not to change things. So if they'll put yourself in their place, you're 50 years old, and the way to get more economic growth is to give up a lot of your protections, your benefits, your pension guarantees, job security, and vacation time. Or you can keep it the way it is, have very little growth, but know that you have a roof over your head, you have a job, you got food in the fridge, and you got plenty of vacation time. They're not incentivized to do this, to go ahead and restructure the economy. And Americans have this, for lack of a better word, fatal flaw. We think that given their druthers, foreigners would love to be like the Americans. This is not necessarily true. People who decide to stay in Italy, Spain, France, even Germany, a more vibrant economy, don't want to be American, don't want to live like Americans. If they did, they'd come to America, and millions of people do. All right, they want to be the best of what they are, their culture, and so they don't have a desire to own an SUV or to buy a 3,000 square foot McMansion or buy everything on credit. That's not their lifestyle. And you have population growth slowing there. You have it declining in Japan. So, and you have the market who did QE for the central banks. They already pushed rates low and weakened the currency. And they've been doing that for a long time, and still no uptick in growth, no uptick in inflation. The EMU CPI came out today of minus 0.2%. You have deflation officially in the Eurozone, okay? So they can launch full-blown QE all they want. All that's going to do is hold down long-term rates. That's all that's going to come out of this, and this bond market, or this, I shouldn't say bond market, I think the bond market has this right. The financial markets right at this time remind me of an old Casey Stengel saying. He said when he was managing the 62 Mets, can anybody here play this game, right? No one seems to understand how interest rates work. What moves short-term rates? What moves long-term rates? What Fed policy is designed to do? How it affects the markets? So we hear comment after comment after comment of experts who are saying when the Fed tightens later this year, then we'll see long-term rates rise. Really? So the Fed's going to raise an overnight rate for the most part, and it'll affect 3-month rates, 6-month rates, up to 2 years. And because of that, because of tighter financial conditions, we'll see long-term rates move higher. Think about this, folks. When in the past, before the days of QE, how did the Fed try to rein in inflation and keep growth within, manageable, so the economy doesn't overheat? It raised the Fed funds rate. Raising the Fed funds rate is anti-inflationary and somewhat anti-growth. So please tell me how raising the Fed funds rate in the face of modest inflation pressures in the United States is going to raise long-term rates. It's probably going to go ahead and start flattening the curve at lower rates than to what we've become accustomed. That's the new normal. It is for now. Is it permanent? Nothing is permanent. Is it closer to historical levels if you take out the 20 years, so 1965 to, or even the 1965 to 1981, 16 years? Yeah, it's closer to that normal. Like in a report we did earlier this week, the 10-year in 1953 was at 2 3/4. The long bond in 1923 was around 430. All right, and it traded in and around those levels in the interim. High rates are not the norm. People think they are, 'cause that's what they remember in their lifetime. But we're low historically. Maybe we're close to normal with given conditions, but we're not that far away from the historical norm. And demographics have changed. So it's possible that we see the yield curve flatten with all rates below 3% within the next couple of years. There's very little signs out there, very few signs out there that we're going to see inflation pressures spike. There's an idea that as the economy picks up here, more people get hired and there's wage pressures. All right. There is a plethora. There are literally boatloads of cheap labor in the world today. And a stronger dollar makes paying them in their home currency cheaper. Lower oil prices make transporting the goods from overseas cheaper. All right. So this deflation in energy prices puts more money in consumers' pockets, but it also makes things produced in the U.S. more expensive. This is why Caterpillar is going to have a problem selling overseas. Ingersoll Rand, even to some extent GE. Their goods are more expensive in overseas markets. Our labor is more expensive now versus overseas than it was 6 months ago. All right. This doesn't mean the U.S. economy is going to go into recession. It means, though, it probably means that we're not going to keep printing at 4 and 5. It probably means that wage growth is stuck in the 2s, maybe in the high 1s. It doesn't sound great. Would you rather be Europe? Would you rather be Japan? You have these two other very large economies that are experiencing a negative demographic situation with already low rates, and low rates which have ceased to be stimulative. There's the idea out there, and we believe it's completely incorrect, that the absolute rate is what is stimulative or restrictive. It's really more the direction of the interest rate. If we had rates at 8 and we went to 5, 5 is a stimulative interest rate. If we had rates at 3 and we went to 5, it's restrictive. And what happens is people build in things. This is why tax cuts stop to be stimulative after a while. Fuel cost cuts stop to be stimulative after a while, and interest rate cuts stop being stimulative after a while, because the consumer becomes accustomed and they price that into their daily expenses. And then when that goes up, even if it's to what might have been considered accommodative or stimulative in the past, it becomes restrictive. So if the Fed came out tomorrow and said, we're bringing the Fed funds rate to 2, you think that would be, people say, oh, that's still stimulative. You'd see corrections all over the place. Okay. Now, when we were at 4 on the Fed funds rate, if the Fed came out and said, we're going to 2, boom, you'd see risk asset prices move. You'd see the markets rally. It's the direction. It's the direction of the change and the rate of change in a given direction that determines whether something is stimulus or not. You have Japan, has 0 rates and a 10-year in the 1s or lower, and they're far lower right now, for 20 years. 20 years, 2 decades. And they can't get the economy off the ground. People have become accustomed to those conditions. They become accustomed to life as it is now. The Europeans are becoming accustomed to life as it is now. Okay? Eventually, Americans will become accustomed to low rates and low fuel prices. And when they go up, it's painful. Now, after a while, the pain goes away if policymakers let it instead of cutting right again, and they'll become accustomed to that. It's like pulling off a Band-Aid. It's going to hurt. You got to do it, though. Right? But that's not in the cards right now. So what we think is the soonest the Fed raises the Fed funds rate is September, the soonest. And the market's already building that in. The market's already building in low inflation for a long time. And with Fed policy keeping inflation in check and keeping long-term rates low. Look, U.S. rates are high, especially long-term rates compared to their foreign counterparts. Jeff Gundlach said it perfect the other day when he said it used to be that Japan stuck out by having extremely low rates much lower than their developed counterparts. Now it's the U.S. that sticks out by having a 10-year yield that's 100 or more basis points higher than its large developed counterparts. And China is slowing down by design. It's maturing. Look, an economy is like when you build a house. Okay, when you build a house, there's a big outlay of capital, and you put a lot of stimulus into the economy. You're buying lumber, wiring, plumbing, carpeting, appliances, furniture, windows, and you're hiring workers to put it all in, right? So that's a big influx into the economy. But when the project is done, you're not doing that every year, right? The amount of growth you put into the economy slows, and when the refrigerator breaks, or when you want to upgrade it because a new model's out, then you'll replace it. When the carpeting wears, or you need a style change, then you'll replace it. But you don't have this big outlay. Well, an economy is like that too, right? You're not going to keep building roads and railroads and ghost cities, and ports after you built them. Okay, you're going to repair them. You're going to upgrade them. It's going to be a more gradual growth. That's normal, So we have it in our head that 3% is normal. Maybe it is, maybe it isn't. Maybe 2% is normal. Maybe 4% is normal. What's normal inflation? The Fed set this quasi target, which they never fully admitted to, of around 2% on core PCE. The Fed's mission is price stability. The Fed's mission isn't price stability at 2%. If you're at 1.5% or 1% and you're steady there, that's stable, right? That's stable inflation. What's their goal? Yeah. So we're in a situation now where, if you look at the minutes of today's Fed meeting, we have the Fed saying, we could tighten even if inflation doesn't pick up. So that don't think that the Fed is not going to tighten because inflation is low. And then the other side of it is, well, why is the Fed going to tighten when it could hurt so many companies? We've said this before, and we've heard other people. We heard O'Leary say it today. Gundlach has said it. A bunch of pundits have said it. There are companies out there that are just consuming capital. They're poorly run, and the capital can be better used elsewhere. The system needs to be clean. We won't say there's a bubble in oil. We won't say there's a bubble in junk, but there are blisters. Okay, money came from places where it never came from before to go to junk. All right. It's not that stuff is selling off for no reason. It was priced beyond reality before. By how much and which companies, we'll know afterwards. You never know how bad a bubble is, or if you have a bubble or a real frothy situation until after the fact. But the difference is retail manages for return. The professionals manage for risk. Okay? In our opinion, there's less risk, less volatility over the long term in midstream than upstream. So that's pipeline versus drilling. Right? Now, you can get big returns sometimes in drilling, but you can also take bigger hits when the commodity price drops. Right? But as long as the tolls are being collected for sending that oil through, the midstream could hold in there. And why the heck are oil or gas drillers and pipelines going down? That's going down because everybody bought sleeves. Buy me energy. Buy me an energy ETF. Buy me an energy fund. Buy me a sleeve. Don't take the time to dig into it. That's not your job. That's not my job. We'll leave that to the manager. You know what? It wasn't like that years ago. And it's not going to be like that going forward. When the Fed pushes all asset prices up, you can do that. When the Fed is not your friend, and the Fed might not be your enemy, but it's not going to be your friend, you can't do that. What about OPEC? All right, we said that already. OPEC is toothless. If it cuts production pops up somewhere else. It used to be that most oil companies were state-owned and state-controlled. Well, welcome to the U.S., Canada, and now a liberalizing Mexico, because they have a capitalist as president, right? So now you have this huge supply of oil that's not state-run. Now, the U.S. can't export crude. It can't export refined products, but Canada can. Mexico can, right? So you can't. It's not like the U.S. oil minister, which we don't have one, thank God, is going to say, we're cutting production. All you producers cut production. They will if they want to. They won't if they don't want to. All right. That didn't exist before. All right. So OPEC can go, we're cutting production. And the US, Canada, Mexico, Malaysia, Nigeria, wherever it might be, Iran, Russia, will go whoop, turn it right back on. They need the revenue. And the Saudis know it. And the Saudis know that the cutting production is not going to, over the longer term, raise the price of oil. Yeah, maybe intraday or for a short period of time you get a spike. Maybe see oil run up to 60, 65, and then the supply comes on and bang, we go down again. They know it, Right? Welcome to the free market. Welcome to competition. This is like having a McDonald's, a Burger King, and a Wendy's all on the same strip of road. And the McDonald's franchise owner says, you know what, these 99-cent cheeseburgers on the dollar menu, I'm not making enough money on them. I'm going to raise my price to $3 for a cheeseburger. Well, Burger King and Wendy's, they keep it where it is. Do you think the McDonald's guy's going to get a juice in revenue? Customers are going to go get the 99-cent cheeseburger everywhere. Even if McDonald's cheeseburger is a little bit better, I'm not paying 3 times as much. So he has no pricing power, and that's the problem. There is no pricing power in oil at this point. So I know we've gone a little over time here. Let's see if we missed anything in our notes here. We did change in rates. The stock market and the bond market. Let's see. People have been arguing over and over again, which is priced correctly, the stock market or the bond market? The answer is, as far as we're concerned, they both are. What do we mean by that? Well, the price for different things. What's the stock market price? And we're talking about, large caps for the most part. The S&P, the Dow. They're pricing for a business-friendly environment going forward. Right? Strong U.S. growth, relatively speaking. Now, foreign economic malaise is going to pull on us a bit, but it's probably not going to stop our growth. All right. They're pricing in low labor costs, which they're going to have. I don't care what anybody. They're going to have that for a long time. Between automation and foreign labor, they're going to have it for a long time. So they're pricing in that. They're pricing good corporate profitability. What's the bond market pricing in? Bond market is pricing in low inflation and low foreign rates that'll keep our rates down. They're both priced correctly. Could they both correct? Could the 10-year yield spike up to 2.5? Could the Dow have a 10 or 15% correction? Yeah, it's possible. But it's probably not the most likely scenario. And as long as U.S. growth stays strong, you probably buy in a big dip like that. But you buy quality. Bill Gross was out there yesterday saying, hey, we got to move up to dividend-paying stocks, low leverage companies. All that. Well, we've been saying that for more than a year. All right. Now, don't think Mr. Gross just came to that, on January 6th yesterday, had an epiphany on the Feast of the Epiphany. No, he didn't do that. He knew. He's talking his book again, but more power to him. He's in a position he could do that. He moved that already. Smart man. We've been saying that too, and contrary to what the wholesalers say, contrary to what the different blogs say, but you know what? We've been right. Gross will be right. Gunlock was right last year. He was righter than we were. And he'll be right again this year, saying similar things. Okay, so it's not that the bond market is priced wrong and the stock market's priced right, or vice versa. They're looking at different things, apples and oranges, and they're both pretty much priced correctly. So with that, we run over by about 8 minutes. We'll let everybody go. The replay will be available. Just to give our disclaimers, investment advice is offered through a registered investment advisor, private advisor group. Both Bond Squad and WSNM LLC are separate entities from Private Advisor Group, but I will say Private Advisor Group have been very helpful, and we thank them for everything. As to the folks at Wealth Strategies and Management who've taken us in and integrated us with the business. Please, if you have any question, give us a call. Our number is 570-424-1555. You can email me at thomas.byrne, that's B-Y-R-N-E, at W as in whiskey, S as in Sierra, the word A-N-D, M as in Mike.com. And with that, have a great week. Have a very happy, healthy, and prosperous 2015. Please stay in touch with us. And we'd like to thank everybody who renewed their subscription this year. Our renewals come in close to 100% every year, and we grow every year. We thank everybody for that. And remember, we can and do manage portfolios on a fee basis, both through financial advisors. Okay, we can do it at your firm, usually with permission. Just call us. We'll work with you, and use our expertise. We've been around a long time, and we kind of know what we're doing. So with that, have a great 2015, and good night. Thank you.